Welcome to Mad Money. Welcome to Cramerica. Other people make friends? I'm just trying to make you a little money. My job is not just to entertain, but to educate, to teach you. So call me 1-800-743-CBC. Tweet me at Jim Cramer. We have two economies. There's the tremendous economy with amazing growth, the one that's connected to artificial intelligence. And then there's the anemic economy connected to the consumer, which seems to deteriorate by the day. Oh, it's a stark contrast. But you can't really see it by looking at the averages. They mask it. Dow declined 174 points. They S&P losing 0.50%. Nasdaq slipping 0.5 today. The AI economy just takes up too much weight in the averages. It makes it harder to see the weaker consumer economy, but it's there, lurking. It's there. Not a day goes by without something monumental happening in the AI economy. It's all the rage because business is that fabulous. Right now, for example, Intel, a once-great semiconductor company that's been left behind by the AI revolution, needs money to get back in the game. Does it turn to a bank? Whoa. No. It's said to be turning to a company much better than a bank. It's turning to Apple. Now, it's not clear at all whether this is really happening. I want people to take a breath here because, there's been no confirmation from either side, and I've been working to try to confirm it for about 48 hours. But it's natural to think that a distressed tech company like Intel would be seeking funds from Apple. Yes, Apple's just that rich, and it's committed to investing $600 billion in the United States. So why wouldn't some of that go to Intel if it asked? Heck, Apple could sub for the U.S. government and help pay for all that pie-in-the-sky stuff that former CEO Pat Gelsinger wanted to do with the CHIPS Act subsidies. Apple could build the foundries that Intel wanted to put up, hoping customers would follow. Okay, so let me step back for a second. That is not Apple's area of expertise. I find all of that to be fanciful. But if it could find a way to use Intel's chips or Intel's foundry, I don't know, it might be worth it in some way, shape, or form. Plus, most important, this would just be an asterisk when it comes to Apple's balance sheet. I'm not even sure it would count as a rounding error. No matter what, Intel can't be allowed to fail, but you need to know that this is the kind of chatter that happens every day because there's so much money sloshing around. What else? This morning, CoreWeave, basically a company that runs data centers for the AI era, announced an expanded agreement with OpenAI, the company behind ChatGPT, for $6.5 billion, bringing its total contract value with OpenAI to $22.4 billion. Now, can you think of any companies in the consumer economy that could sign a deal for $6.5 billion like that? I know I can't. But when the CoreWeave news broke, when I was sitting right over there at Squawk on the Street this morning, I couldn't even tell if it was worth mentioning. Yes, there's that much AI-related activity out there. I didn't want to cut into Carl and David and say, hey, guys, 6.5. It just didn't seem to be worth it. Or how about Meta? Now, it's building a gigantic $10 billion data center in Louisiana. This thing's such a monster that it had to contract directly with a big utility in the state that's been on many times, Entergy, which is building 3 new gas power plants to fuel it. That's equal to 1/5 of the power that Entergy currently produces. We're hearing rumblings just today, though, about whether the regular consumers of power could be hurt by this deal. That's a new theme. Regular consumers of electricity being hurt by these humongous companies. Who ever heard of any other company impacting a state with its electricity needs? But these data center behemoths put so much stress on the grid these days that fighting them, well, let's say that we're going to be hearing about fights between consumers and tech for a long time. All right, now let's deal with the other side. Let's deal with the so-called regular economy. I have to tell you, it is rough out there, really rough. This morning, we got results from CarMax. Oh, my. The country's largest used car dealer. They were awful, causing the stock to plunge 20%. Sales were 6% below Wall Street expectations. There was an incredibly weak unit volume. Profit per car was below expectations. Big loan losses, too. Every line was suboptimal. What could help CarMax make the numbers? Well, you know exactly what. A bunch of rate cuts. Their customers need lower rates as auto loans are priced off the shorter end of the yield curve, mainly 2- and 3-year rates, ones that would come down if the Fed keeps cutting interest rates. CarMax is a very good operator, by the way, but unless rates come down substantially, I think things will only get worse for this company. People think it's a dog. It's not. Or consider KB Home, one of my favorites, excellent home builder. Plenty on it coming up later in the show. It's literally choosing to build fewer homes because it knows it's going to have a hard time selling them. Interest rates are incredibly important to the home builders, and KB Homes doesn't mince words. Rates are simply too high. Now, you could argue that mortgages are priced off the long end of the curve, 30 years. That's the bond market that's in play, not the Fed. But if the Fed could take rates down substantially, then banks could offer customers a short-term teaser rate. I bought one of those when I first got out of law school. That might breathe some life into this industry. We need more homes built because housing punches above its weight in the U.S. economy, as it's connected to so many other industries. Practically everything in the languishing pre-AI economy starts or is connected to housing. Finally, there's Starbucks, which today announced that they were laying off 900 corporate workers, as they also told us they'd be shrinking their North American store count by 1% this year. It's a $1 billion restructuring plan. It's meant to make Starbucks more profitable. You could argue that this could have been done at any time, but I think Starbucks is part of the real economy. And the real economy, it stinks. I remain very bullish, though. I think CEO Brian Nichols' plan to get Starbucks back on track is terrific. And I advise members of the CNBC Investing Club in our morning meeting streaming show, do some buying. Buy. It's going to send the earnings up, not down. Autos, housing, retail, these are the foundation of our economy. You think these groups will be growing well with 3.8% GDP growth in the second quarter? This is the page we learned about just this morning. But remember, those numbers that J.P. Morgan strategist Michael Semblis wrote about in yesterday's edition of the Eye on the Market, AI-related stocks have accounted for 75% of the S&P's returns, 80% of the earnings growth, 90% of its capital spending since ChatGPT launched in late 2022. And remember, NVIDIA allowed that to happen because it's based on NVIDIA. Apple alone has committed to an investment program that's actually larger than the entire commitment by the U.S. government to building the interstate highway system, which was the biggest public works project in our nation's history. Of course, this is a very tricky moment. President Trump can say that the economy is very strong, but we still need rate cuts because the part of the economy that's consumer-oriented is weak and getting weaker, even as the part that's related to AI hiring is hiring like mad. It's rolling in money. One thing's for certain. Without rate cuts, we aren't going to get more homes because some of the largest home builders, like KB Homes, would rather just buy back stock than build homes. We know the CarMax used car weakness isn't just going to stay with used cars. It'll be new cars, too. In retail, after years of retrenchment, a lot of thanks to digital competition, retailers still have too many workers, too many stores. Only an outfit like Walmart, which has the same scale as Amazon or Costco, can compete without worrying about its balance sheet. Oh, and by the way, Costco reported this very evening. The numbers were fine. Costco does not trade like other companies. We kind of knew how they were doing. Not enough catalyst. That's why it's weaker. Now, I know it sounds crazy to suggest that we need rate cuts when prices are still elevated, often in self-inflicted ways, I think tariffs, and we have a very strong 3.8% GDP growth. But the strength is in tech, and there's just not much intersection between tech and the day-to-day life of our workforce or our lives, except maybe with cell phones. Here's the bottom line. The writing is on the wall for a big chunk of the economy if we don't get more rate cuts. Things are going to keep sinking. The other part, the AI part, is totally indifferent to rates. Most of these companies will never need to raise money. Even if they do, it seems like they just sell equity to their deep-pocketed business partners. High rates for them just means higher returns because they have so much cash earning interest more than any time in financial history. Patty in New Jersey. Patty.
Hi, Jim. I'm a first-time caller. Hi, Jim.
Okay.
I'm a first-time caller, but I've been watching Mad Money for a long time and truly appreciate your valuable insights.
Thank you.
I would like to know your take on Marvel Technology, MRVL. Is it at an inflection point to ride the strong AI and data center growth that we have been seeing it? Should I add to my position?
think absolutely right. And it just announced a big buyback, and it's had a lot of insider buying. And I've got to tell you, this company has felt very maligned. Marvell is really an excellent company. Matt Murphy's done a fantastic job. It has been creeping up ever since the so-called disappointment. It was up 3.7 today. You got a winner. I need to go to Marcia in Washington, please. Marcia.
Hi, Jim. I'm a club member and second-time caller. And
Yes.
I'd like your opinion on Sterling Infrastructure, SPRL.
Well, this is a very interesting one. We're getting a lot of these infrastructure plays. This is a very, very good company. It has moved up a great deal. It's a civil engineer company. I think we have to wait for it to cool off, Marcia, but it is a real winner. It's just got a very high price to earnings multiple. Anyway, I do like it, though. I know it's hard to advocate for rate cuts with elevated prices and strong GDP growth, but the writing is on the wall for a big chunk of the economy if we don't get rate relief soon. And it's not good. On Mad Money tonight, I'm homing in on the housing market after recent reports from KB Home and Lennar and sharing if I think now's the right time to buy this cohort. Then I'm going off the charts to see if we're nearing a top in the market or if this rally still has some legs to it despite the last 3 days. And we covered Aquestive Therapeutics last week, but there's nothing better than going right to the source. I'll have the company's top brass on to learn more about the story. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Over the summer, many of the home builders started rallying in anticipation of rate cuts from the Fed. But now the Fed started cutting and the group keeps rolling over. So what's going on here? Didn't we want rate cuts to jolt the industry out of the doldrums? Well, let's look at what happened when some of the key home builders recently reported. First, we got Lennar, the Miami-based developer that's become one of the largest home builders in the country. Lennar kicked things off last Thursday when they reported after the close. On the conference call, management acknowledged that with an easier Fed, investors had begun to expect and anticipate an improved housing environment, hinting that we might be seeing the beginnings of that now. However, Lennar quickly threw cold water on those hopes, following up these comments by stating, and I'm going to quote here, "With that said, our third quarter results reflect the continued softening of market conditions and affordability through our third quarter," end quote. Ouch! Not exactly what investors were hoping to hear. Lennar posted weaker than expected revenue with lower than expected deliveries and average selling prices that were merely in line with expectations. The housing gross margin, 17.5%. That's 30 basis points lower than anticipated, 500 basis points lower than the year before. Needless to say, the earnings were not that good. Even worse, Lennar says their earnings for the current quarter are likely to come in below the expectation. And remember, Lennar is a fantastic company. As management explained on the conference call, while they ultimately delivered more units than they expected last quarter, those sales required additional incentives to lure people in which is what crushed the gross margins. Incentives mean, of course, they cut the price in order to get people to buy. Going forward, Lennar wants to be less promotional, but who knows if they can really make it happen. So if you were looking for some unapologetically positive commentary on the state of the housing market, Lennar, Stuart Miller, CEO, he didn't give it to you. While some investors were hopeful that just the expectations of lower interest rates would be enough to jumpstart sales, management took much more of a curb your enthusiasm approach. Listen to this. Quote, "Even though mortgage rates began to trend downward towards the end of the quarter, stronger sales have not yet followed." However, they also talked about, quote, "early signs of greater customer interest and stronger traffic entering the market," end quote, and said that interest rates continue to fall. They're quite optimistic that stronger sales activity will come soon. So maybe you want to call it green shoots and that things can get better if rates continue to come down. Could be worse, but it's not what the bulls were really hoping for. On a more optimistic note, management acknowledged that because of the extended period of high interest rates, Lennar has been forced to cut its construction costs in an effort to make housing more affordable. Going forward, management believes this leaner cost structure will allow them to clean up once the housing market rebounds, and they're pretty confident that as mortgage rates approach the 6% level or lower, demand really will start to kick in. Buy. Right now, we're at roughly 6.4% for a 30-year fixed mortgage. Now, that's far cry from 7%. Plus, rates we were getting, those are the rates we were getting at the beginning of the year. But you see, it's still up slightly from the sub 6.2% level we had just before the Fed cut rates. Like everybody else in the industry, Lennar needs lower long-term interest rates. Usually when the Fed cuts short rates, long rates will come down too. But that's not always the case. Last fall, for instance, the Fed cut short rates and long rates skyrocketed. Worth keeping in mind. I mean, I know I'm very concerned that we could repeat last year's fiasco as long rates are still creeping up higher after that last recent rate cut. That's not good. Next up, KB Homes reported last night, and even though it was another really good home builder, by the way, even though it's more encouraging than Lennar, it wasn't that much better. KB Homes actually posted notably better than expected sales. Average selling price came in a bit above expectations, too. Better than expected deliveries, although both of those were still down year over year. The gross margin also came in ahead of the consensus estimate, leading to a nice bottom line beat. Despite those generally better than expected results, though, KB Homes still cut their full year sales forecast by a sizable amount. How about the commentary? Management's adamant that the long-term outlook for housing remains favorable, driven by both demographics and shortage of homes. As for the shorter-term outlook, KB Home saw some positive signs starting in June with price stability and demand, and that continued as the quarter progressed. They also find the decline in mortgage rates encouraging, although apparently not encouraging enough for them to maintain that full-year sales forecast. Still, management did something I thought was very useful in the conference call. They broke out in detail what lower mortgage rates mean for their business and for the customer. Mortgage rates have fallen roughly 60 basis points from earlier this year. And the company says that adds $30,000 of purchasing power based on their average selling price. Now, that's a good chunk of change, especially for the first-time home buyers or those looking to upgrade for the first time, groups that make up 70% of KB Home's customers. This is, in other words, a group of more moderately income people. The company seems to be taking a different approach than Lennar, which got very promotional last quarter in order to sell more units. KB Home maintains they don't need to chase incremental volume right now. Currently, they say speculative builders, spec builders, are discounting heavily to close out the year, and they don't want to crush their own margins by trying to compete with that. That said, while management noted that orders have been good, they also said, quote, I wouldn't say that we've seen a big uptick yet, or maybe the uptick that we would expect to see from such a change in mortgage rates. Not ideal. As for why that's the case, listen to this, quote, I think to some extent buyers are in maybe a bit of a wait-and-see mode, end quote, noting that potential home buyers might be waiting for rates to come down even further before they pull the trigger. And I think that's exactly what is happening. Exactly. See, they'd rather, KB Homes would rather buy back stock if it comes down a little bit more than just put up homes for the sake of putting up homes, especially if the gross margins are going to decline, as they think it would happen in December. So what have we learned from these home builders so far? In short, based on commentary from Lennar and KB Home, the bulls clearly got ahead of themselves here, because so far we haven't seen any meaningful increase in sales volume driven by lower mortgage rates. So let me give you the bottom line here on this really important industry, as I said at the top of the show. Lennar and KB Home need lower mortgage rates in order to win, and both companies sounded optimistic about the prospect of those rates coming down. But man, ever since the Fed cut short rates last week, long rates have been on the rise again. That's why I think it's better to take a wait-and-see approach to the home builders, just in case we see a repeat of last fall, where the Fed started cutting and it didn't make a difference. If anything, it drove the bond market in the wrong direction and mortgage rates higher. Mad Money's back after the break.
Coming up, tax on top again. But is this a 2000 redux? Forget the boy bands and low-rise jeans. Cramer is taking to the charts to see what the rally's really signaling. Next.
Now, you know, last night I got a little worried about these froth levels. I mean, we've seen many ultra-speculative stocks shooting to the stratosphere, even though most of them have no earnings. Some of them have barely any revenue. I've been willing to recommend many of these specs on the way up, but at a certain point, these moves give me vertigo, making me nervous about the broader market, too. I actually thought it was reassuring today that the specs got clobbered. I never want anyone to lose money, but we needed this. Still, ever since the averages bottomed in April, it has been a mistake to bet against this market. So tonight, I want to expose you to a more sanguine worldview, which is why we're going off the charts a second time this week. This time with the help of Jessica Inskip. She's that first woman on the active trader desk at Fidelity, who's now director of investor research at stockbrokers.com, as well as the co-host and founder of her Market Maker podcast. She's got a very good track record lately. And right now, Inskip is adamant. This was such a reassuring thing to me, that this moment is not the year 2000. This market is not toppy. If anything, she thinks this market's got legs. Why? First, take a look at this chart of the sector weightings in the S&P 500 going back to the 90s. All right. Inskip points out that even though the S&P is increasingly tech-heavy these days, with information technology making up 33.48% of the index, up from 20% in early 2019, that's nowhere near what happened during the dot-com era. Back in 1994, tech accounted for just 6% of the S&P. By the year of 2000, it was 28.4%. That is more than 22 percentage points increase over the course of the dot-com era. Over the past 6 years, tech's weighting in the S&P is up only less than 14 points. Okay, so it's slow, it's gradual. See, she thinks that it was the velocity of the change that created the bubble in the 90s. And so far, we haven't seen anything close to what we saw in the 90s. If you want to insist on a dot-com comparison, I say, look at the chart. The current moment feels more like 1998. And that was a great time to be a buyer. Now, Inskip recognizes that Wall Street often slaps an overvalued label on the S&P 500 when its forward price to earnings multiple gets close to 25 times earnings, basically where we are right now. However, today's S&P is not like the S&P of 10 or 20 years ago. The sector mix has changed dramatically. Like I just mentioned, there's a lot more tech in the index these days, so maybe we shouldn't be so focused on the index-wide multiple. In my book, my new book comes out next week, How to Make Money in Any Market, I describe the multiple. If you don't know what the multiple is, the book will really help, okay, because I know it's a complex term. Now, take a look at this daily chart of the S&P 500 in red with the forward price to earnings multiple of the information technology sector in blue. Okay, see that? It's a complex term, but we're going to deal with it. Most technicians don't overlay the price to earnings multiple on top of the price action. But Inskip likes doing this because it's a great way to tell if prices are moving too far, too fast relative to earnings. I love this chart. Inskip has found that the S&P 500 tends to sputter when the tech sector's forward price to earnings multiple gets above 34. But we're not there yet. Tech sector's forward PE multiple currently in the low 30s. So she thinks we've still got a little more room for multiple expansion before it starts feeling like the market's come up too far too fast. Plus, when you look at the good old weekly chart of the S&P 500, this is really positive. Inskip likes what you see. For starters, the S&P still has a bullish trading cycle. Inskip watches its 13-week, okay, the 26-week, and the 40-week. Moving averages because they represent 1, 2, and 3 quarters worth of action. Remember, the quarter is the basic unit of timekeeping in this business. Right now, all 3 of these key moving averages are sloping upwards. See that? It's slope. It's not this, but that's okay. We don't want that. And acting as floors of support underneath the index. Right now, she points out that we've got a floor at 6430. There's the 6430 floor. Okay. With 13-week moving average, and then we got another floor at 6147. Okay. These are all good floors, and that was a high set back in mid-February. Last time we spoke to Inskip in early August, she was watching the Bollinger Bands, these purple lines above and below the price action that represent the level of volatility. Specifically, she wanted to see those bands narrow, and that's exactly what's happened. See, here and then down to here. More importantly, Inskip's watching the RSI, the Relative Strength Index, down here at the bottom. This is an important momentum indicator, and it reached levels very close to what many technicians would call overvalued. Anything above 70 is usually that. It's considered a red flag. But Inskip says we only need to worry about the RSI when it reaches higher highs while the S&P fails to make a new high. This is an indicator that helps measure when we've come up too far too fast. But so far, Inskip doesn't see it. However, if the RSI starts retreating, and then that's why she'd be worried. So don't be fearful about this. It's fine. How about the weekly chart of the S&P 500, but this time the equal weight? This is very, very significant. Why? Because this is the other companies that aren't so big. This weighs all the stocks in the index equally rather than by market capitalization. We look at this because it shows you what's happening with the 493 stocks that aren't part of the Magnificent Seven. So this represents whether we're narrow or broad. Right now, Inskip points out that this S&P equal weight finally gave us that higher high that she wanted so badly. To her, this is a signal that the market's broadening again after a period where we were stuck with a very narrow tech-led rally. Now that the S&P's equal weight has broken through its ceiling of resistance at 7612, that's our ceiling resistance, and it broke through right there. That's the level's new floor of support. It extends from the high back in November of last year when the market soared after the election, only to be derailed by rising long-term interest rates. The regular market cap weighted S&P took out its highs from last November way back in June. So we go back here and we can see it took out the highs. The S&P equal weight didn't do the same until mid-August, but at least we got there. As long as the S&P equal weight stays above this floor that we're talking about, well, you know what? She thinks this rally can continue to broaden. And remember, it's all concentrated in the Mag 7. A lot of people really do freak out. I don't, but people do. When you look at the relative strength index for the S&P equal weight, it's having a hard time confirming the index's recent highs. It's kind of doing nothing there, right? Instead, the RSI has been leveling out. To Inskip, this predicts sideways action that requires a new catalyst to move the index higher or lower. But she's betting that the next catalyst will be positive. So in other words, mark time, and then positive catalyst. Finally, how about the weekly chart of the XLK? That's the Technology Select Sector Spider Fund relative to the dollar index. Isn't this interesting? We've got the dollar index and then the XLK separately down at the bottom, all right? Inskip wanted to point out this because, as you can see, there's a very strong relationship between a weakening dollar and strengthening tech stocks. That's kind of interesting, I felt, right? But that's a lot of that's overseas sales. Last time we checked in with her, she said that XLK would rally with a stable weakening dollar. We got stability and the tech ETF soared. Let's hope the dollar stays relatively soft because that could justify how we're doing here. It's obviously a nice run as the dollar got weaker. Very positive. The bottom line here. I know I threw a lot at you, but the charts as interpreted by Jessica Inskip suggest that this market's actually in much better shape than many people you hear come on TV and say it's the end of the world. It's 2000. She doesn't think we've come up too far too fast. If anything, she says this bull market's still got legs, especially as long as the dollar doesn't make a comeback. Let's take some calls. Let's go to Frank in Florida. Frank.
Hi, Jim. Booyah from
Booyah,
Vero
Frank.
Beach. How are you?
Oh, God, Vero Beach. Oh, my God. The ESPYs live there. I'd say hi to them.
That's great. It's a great area.
Okay.
We absolutely love it.
It's fabulous.
It is. Thank you. You need to come visit us. Long-time listener, first-time caller. I love your show. We do have something in common. I was a student in Tallahassee at Florida State when you were starting out as a reporter in the late 70s.
You were at Tallahassee? You were at Tallahassee?
Oh, yeah. Tallahassee.
I was right next to Jim and Milt's.
Oh, were you really? I ate there many times. I'm sorry.
Best
it
in
closed
show.
down a few years ago. But that was
all
the
right.
best breakfast and barbecue. But
absolutely.
Anyway,
Let's go to work.
We were able, one quick thing I wanted to say, we were able to witness Bobby Bowden starting that football program. And
Of course I did. What, are you kidding me? What are you like? You think I'm a naif? Of course. All right, let's go.
Yeah, he's great. And Coach Norvell has the team back in the top 10 and said, go Knowles, baby.
Well, good quarterback. We'll always do it. All right.
That's great.
How do we do it? What are we doing here?
My question for you is, I've owned Coke stock for almost as long as Warren Buffett. What are your short-term and long-term thoughts on it?
I think it's a terrific stock. It's one of the few consumer packaged goods companies that really has a lot of momentum. The stock's come down a bit. I think it's a great level to buy, and I think James Quincy is terrific, and I think you're terrific, too. It was great to talk to someone, Tallahassee and Vero Beach. I mean, we are kindred. I can't believe we don't know each other. We probably bumped into each other, big daddies. You know, between the 6 and 7 o'clock when the drink's only 15 cents. All right, the charts is interpreted by Jessica Inskip put into a market in a better shape than a lot of people believe. And as long as we don't go higher too fast, she thinks we're in good shape. Much more mad ahead, including my sit down with Aquestive Therapeutics, a company aiming to revolutionize how to treat severe allergic reactions like the one that I got to anchovies. And we'll hear more about the plans from the CEO himself. Then speculative stocks of all shapes and sizes sold off today. I'm breaking down what the shakeout could mean for you. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. Two weeks ago, I got this call from Andrew in California who wanted to know about a biotech company called Aquestive Therapeutics. Now, I didn't know this one. He gave me the whole pitch, talked about how they've got a replacement for the EpiPen. It dissolves in your mouth rather than needing to be stabbed into your body. Because I wasn't familiar with this one, I circled back last Thursday, and after doing some homework, I gave it my blessing for speculation. This is the kind of stock I like to speculate in. So far, it's only been a week. Stock's up 6.5%. But if the FDA approves their treatment for anaphylactic shock, a lot more upside. Don't take it from me. Let's hear from Dan Barber. He's the president and CEO of Aquestive Therapeutics to get a better read of the situation. Mr. Barber, welcome to Mad Money.
Thank you, Jim. Thank you so much for having me. Excited to be here.
Absolutely. Look, I think you've got a winner. I want people to understand exactly what you do and the mechanism and why it's preferable for those who didn't catch two pieces already that we've done. And I just think sometimes when you have a really interesting spec, you should pursue it.
Sure. If you're okay, I'll tell a little history of the company because it kind of gets you there. We've actually been around for about 2 decades. And over those 2 decades, we have 6 approvals with the FDA. We have product that is sold in 6 continents. We have 2.5 billion doses we put in the hands of patients. But the problem with Aquestive, as you pointed out last week on your show, is we've always been small. We've always been $50 to $70 million in revenue.
Niche. Yeah. We don't want niche. We want broad.
But now, with our new product, our Anafilm product, we finally have a potential blockbuster product on our hands. It's under review with the FDA right now. And when I say blockbuster, in my mind, I think it could be $1 billion worldwide at peak. To have $1 billion drug, you've got to do something pretty special, right?
Absolutely.
So with our product, we have the first and only oral rescue medication for the treatment of anaphylaxis. And you asked about how it works. We actually had to take both of our technologies to make the product. The first technology is oral thin film, which if you can envision a little film that's a stamp that you put under your tongue, dissolves in a couple of seconds, and starts working right away. That's our technology. We call it farm film. And I actually, if you're okay, I brought a sample for you today to see.
No, I want to see it.
This is what it looks like. If you
That's
see,
like a business card.
Yeah, if you see the white right here, that's the foil that actually holds the film. So what we love about this technology is you can take it wherever you go, right? It's an extension of you. So from our perspective, when you talk about a rescue medication, that fits right in the need. In fact, I have a good friend who was saying to me the other day that when she leaves the house, she forgets things all the time, but she never forgets her wallet, her keys, or her phone. So wallet, keys, phone, we're always with you.
Well, Dan, I got to tell you, one of the reasons why I am so intrigued by you is that I have it. I have anaphylactic shock.
I heard, yes.
And I was carrying one. I don't want to pick one, but it's a 30-minute one, and it's a big orange one. Let's call it that. And after 2 years, I said, "The hell with it. Nothing's happened. The hell with it." Because I didn't want to carry it everywhere, and it was always in my coat pocket, no matter what. And it was I could put it in my jacket pocket. And I said, "No, this is too cumbersome. I'll just be more careful about what I eat." But I'll tell you something. I'm scared to death that I'll be eaten by. I'm one of those guys that any allergies. Yes, I have anchovies because anchovies will kill me.
Yeah, no, you're not unique. In fact, when we talk with patients and we're out in the community, the majority of people don't have their rescue product with them. Right. And the majority of times that an event happens, there's not a rescue product available. And when you look at why, you hit some of the real reasons. People think they can avoid it. Right. They don't want to go home if they forgot it. They don't want to carry it with them. I mean, just the other day, TJ Watt, a famous football player, said, "Look, I know I'm supposed to carry it, but I just don't." And actually, you and I were just talking about we live in the same town in New Jersey. My son at his high school prom had 3 kids who went to the emergency room because the place that threw the prom put chicken out and put a peanut sauce over the chicken without labeling it.
Why?
And none of those kids had an auto-injector with them. One of them is a good friend of my family and said, "Well, if I had the film, I would have had it with me."
Absolutely. No, it would. Now, okay, so the FDA obviously must want this because they know that people do exactly what you just described. So what's the process right now? Because it sounds like that they're kind of fast-tracking it, but I don't want to ever it's a new FDA. I don't want to get ahead of it. So, you know what I mean?
Yeah, well, I wish it was fast-tracked. It is fast-track designated, but we do have a standard review time. So we filed at the end of March. We have an action date. So the action date's when the FDA will give you an answer of January 31st. And we recently found out sometimes the FDA will ask for an advisory committee meeting. Right. And they want experts to weigh in on your program. They had warned us they might want one. And they actually just recently said to us, we don't need an advisory committee meeting. So we feel really good about where we are with the FDA right now.
Okay, now, I'm trying to figure out that $1 billion total addressable market. I know 95% of people believe a film dosing option fits an unmet need in the epinephrine market. Are you thinking that if it was approved, therefore you would see the market expand? Because people right now are keeping the market down just by the fact that they're willing to risk it.
That's right. It's about $1 billion market worldwide right now. It's 800 million in the US or so. But there's 5 million scripts written a year. The prevalence rate, so the number of people who should have a rescue product with them, is actually over 30 million. So as you know, with drugs, you're never going to get to the prevalence rate. But with awareness, with a better product, and with the natural growth rate in the market, we think going from 5 to 10 million is very doable in the next few years.
Now, I just want to ask, because I know someone who has this one, and it's a tough one, alopecia. You've got something, but that's a little further away, right?
It is.
But is there any hope?
Yeah, well, and I'm really glad you brought that up because Anafilm is based on our Adrenoverse technology. And Adrenoverse is adrenaline, and verse means we have multiple, right? And what that technology does is it takes epinephrine, which is a very powerful molecule, right? Yes. We make it in our bodies, but it's a very hard molecule to control. It doesn't like to be absorbed, and it metabolizes very fast. So what we can do with our technology, get it to absorb and have different release rates. So now we have Anafilm, where we've created that with our Adrenoverse technology. Alopecia areata will be our next one, so different release profile, and we'll have more products after that. So when I look at where we are right now with that platform, I think we have a long ways to go.
I agree. Well, again, I reiterate that this is just something that hit our radar screen because of a very good viewer. That's how a lot of individual ideas come from our viewers. And this was terrific that I didn't know you were from Summit, but that it's been brought forward because I believe. Anyway, that's Dan Barber's president and CEO of Aquestive Therapeutics. Guys, they have so many very clear, easy-to-read documents. You will understand it very well, and I think it's certainly worth speculating in. Mad Money's back in for the break. Thank you.
Coming up, lightning doesn't just strike twice in Cramerica.
Booyah, Jimmy Chill. Booyah, booyah, booyah.
Thanks for taking my call.
It strikes every day. Cramer is back in a flash with your questions. Next.
It is time to talk to the Lightning Round. Remember that Robert Gold every 10 minutes. Talking about buy, sell, salt, sugar, stock questions. That's my step first. The weapons of the probably planet sound. And then the lightning round is over. Are you ready? Ski dash on the lightning round. Clears. Might start with Connor in Florida. Connor.
Booyah! How we doing, Cramer?
I'm doing real well. How about you, Chief?
Great, man. I'm calling in from Chip and Bug Wealth headquarters at FSU. Go Noles!
Go Noles is right. Absolutely. Good
All right, I got a
QB.
great
Let's go to
one
work.
for you here. There's some speculation around this one. I just recently bought quite a bit. Tell me how you feel about Bros, Dutch Bros.
I like Dutch Bros. Now, let me tell you something about Dutch Bros. This stock has now come down from 86 to 53 as the speculative froth comes out of it. I would say buy some here and then buy some in the 40s. And I think you'll be in very good shape. Don't expect to get back always in the 30s. That'd be way, way too cheap. Peter, New York. Peter.
Hey, Jim. Congratulations on 20-plus years on Mad Money.
Thank you, boss. Thank you.
And 37 years or more helping us folks make money.
Well, that's the plan. That's been the plan for almost 4 decades. Holy cow. What's up?
Oh, I know. I know. Well, your staff is super. Josh and Sean are second to none. A quick shout out to my mom, Elizabeth, who turned 107 last May and isn't doing as well as we wanted to be. But she always said quite often. Yeah, okay. I know. She always said quite often, we watch Mad Money together, that you had a lot of gumption.
Yeah, I got the gumption.
I asked her, Mom, what's that? What do you mean? It says implying a smart, spirited drive, resourcefulness, common sense with added humor. She always got a kick out of you, Jim.
That's great. Tell her I'm owned by no one. That also helps. Owned by no one. Let's go to work.
That's right, sir. My stock is ABTC, American Bitcoin.
Okay, this is a total spec, as you know. It's a very inexpensive, dollar amount, but it may be an expensive actual amount because it doesn't have any earnings. It's a spec. It's your one spec. As I say, in How to Make Money in Any Market, you're entitled to one spec. That's it. But that could lose everything. Just as long as you know that, that's fine. Let's go to Trey in Minnesota. Trey.
Hey, Cramer, I pre-ordered your book, and I can't wait to get it next week.
Thank you. You're very kind. Talking about the book. Let's go to work.
Yeah. Today, Larry Ellison has called AI-powered drug design a multi-trillion-dollar industry. One AI drug discovery stock that has the backing of your favorite NVIDIA is Recursion Pharmaceuticals. What do you think about taking a speculative
I don't know. It's been such a dog. It's been a dog. We had them more, twice the price. It's done absolutely nothing. I need to see a proof of concept here. I absolutely know that NVIDIA's in it, but you know what? This stock has been a bad stock. We need to see something good before I tell you I would put any money in it. Let's go to Ike in Georgia. Ike.
Booyah, Jim.
Booyah, Ike. What's going on?
Not much. Thanks for all you do, man.
Oh, thank you.
Yes. RSG has been a steady performer in my portfolio with strong cash flow and dividend growth, but with rising long-term interest rate and pressure on infrastructure spending.
Okay. Yep.
Republic Service, a trash to treasure or time to die.
I don't understand this in WM. The old waste management, they're both so good, and they just do nothing but go down. I need to see a bounce. As Jeff Marks would say, how about a bounce? And I agree. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up, speculative high flyers got grounded. Is it a warning or a wake-up call? Cramer breaks it down. Next.
Booyah, Jim. Your integrity makes you the booyah saint of Wall Street. Booyah, Jimmy Chill.
Booyah, Jimmy Chill.
Booyah, Jim.
Quadruple. That's a lot of booyahs. When I said I was done with aggressive speculation the other night, it looks like, well, I wasn't alone. Today, the anvil landed hard on that entire cohort. I'm not sure if the bloodletting's over. Sellers clobbered the nuclear stocks, hammered the crypto stocks, nailed the quantum stocks, trashed the speculative healthcare stocks. I don't know which is the chicken and which is the egg, but the actual cryptocurrency declines were brutal. Ethereum down nearly 7% today. It was a powerful reminder of just how fraught these speculative plays can be. What caused it? Well, first, we finally saw some big insider sales like I've been looking for, this time in Oklo, the hottest nuclear reactor stock, including from Michael Klein, a board member, one of the company's top shareholders, and from the company's husband and wife co-founders, who currently serve as CEO and COO, respectively. It wasn't the equivalent of a raft of selling, but it sure got noticed. On top of that, this was still one more day where higher interest rates are just plaguing us, okay? Historically, higher rates are the kiss of death for this kind of speculation. We got to be aware of this. But what I found most ironic was an actual real-life example of the power of IBM's quantum computing product versus the other ones that we've been talking about. HSBC, a giant bank, used IBM's Heron quantum processor to improve its algorithmic bond trading. It produced a 34% improvement in trade predictions. The irony of an old line company beating the pants off of its younger competitors. Although, by the way, I point out that many of these younger quantum plays aren't that young. They've been around for a long time without coming up with something as practical as what IBM has already developed. Maybe IBM is the best way to invest in crypto, in quantum, and it's a mighty inexpensive stock. I spent a lot of time with IBM recently. I wish we owned it for the charitable trust, frankly. It looks that good. Honestly, I'm relieved to see these speculative stocks come in. I never mind when the froth comes out of the market. We don't want huge gains in flailing crypto outfits, and we certainly don't want endless speculation in instruments designed to double or triple the impact of a given stock or index on a day. We don't want insider selling, and we advocate investing around here, not trading. While the specs got hit today, the quality growth stocks and the bank stock performed well. So let today be the lesson this market needs to get back to planet Earth. We know that the speculative excess of 1999 bled into 2000 and led to gigantic losses for pretty much everything. The declines were so great that many people never came back to stocks again. I'd say that it's not yet safe to get back into the speculative water. The shakeout today led to a bounce, but I don't know how realistic the bounce will be. Proving it, it could prove to be that what's going on is that money's going back into quality stocks, with the exception of healthcare, which is a disaster. But I want to make one point clear. My new book, okay, here I go, How to Make Money in Any Market, comes out next week. It'll be signing books at the Barnes & Noble at 555 Fifth Avenue next Tuesday at noon. In the book, I say that if you've got a diversified portfolio of 5 stocks, one of them can be speculative. But you got to speculate wisely. You can't just buy anything. You have to be sure that the company has an edge, as well as a strong enough balance sheet to get the business where it needs to go. And you have to believe in the concept enough that you won't be shaken out if the stock gets hit like on days like today. Even when you speculate wisely, though, I want to remind you that sometimes these stocks may never pan out. In the last few months, people have made fortunes in speculation. If you're one of them, you can still take something off the table so that you're playing with the house's money. You can do that tomorrow. You'd be a fool not to. Speculation only works if you can work toward taking out your cost basis. When you do, you can let the rest run. But if you never take anything off the table, you'll never have any real gains. And speculative gains can always turn into real losses. I like to say there's always a bull market somewhere. I promise I'll find it just for you right here on Mad Money. I'm Jim Cramer. I'll see you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.